Howdy, folks. Welcome to Liberty Call. Today is Wednesday, Hump Day, February 21st, 2024. Hope you're having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado. What is the temperature today? It's probably in the 50s or maybe even up, 53 degrees right now. So it's downright balmy. I saw my favorite meteorologist here in Colorado that I follow. He's not with any of the stations. He just does it on his own. He was showing that out on the Eastern Plains that they had like 70-degree temperatures today. So, whoo! Again, it doesn't last too long out here. Unfortunately, we're due for some more cold, so that's just the way it is. But I'll take the milder temperatures for a few days. So, anyways, all right. Well, like I said, I hope you're having a good day out there. And if you could do me a favor, if it is your first time watching Liberty Call, if you could give me some thumbs up, likes, shares, subscribes, follows, and press that notification bell, because again, you don't want to miss anything out. Yesterday's broadcast was amazing. You got to go back and watch it. And if you're watching the first time, I smacked my head with a hammer. So didn't need stitches. It just made a big bloody mess. All right, let's go ahead and get into the numbers for today. Kind of a weird market. Dow Jones finished in the green, up 0.13%, 48 points, closed at 38,612. The S&P 500 up 0.12%, closed at 49,81. NASDAQ down 0.32%, closed at 15,580. And actually, let me bring up my chart here. This is the Dow Jones today. And you can see it opened up down about 0.5%. It was down most, until the Fed minutes came out. And it went down as far as about 0.63, and then just rocketed up in the last, hour or so, or half hour of the markets. Just very, very strange. The NASDAQ, same thing, big rally here in the last part of the day. Unfortunately for the NASDAQ, did not get back above that flat line. And the S&P, these are still ticking along because this chart's 15 minutes behind. The S&P 500, again, down most of the day, took at its lowest was down about a little more than 0.5%. And then, like we said, it finished in the green, 0.12 today. So again, just a strange market. All right, let's get back into the numbers. The VIX was down at the close, 0.65%. It's currently at 1532. Canada down 0.21, Brazil down 0.03, and Mexico down 0.38. In Europe, Germany was up 0.29%, the UK down 0.73%, France up 0.22%, the Netherlands down 0.18%, Spain up 0.69%, nice. Italy up 1% even, Switzerland down 0.25%, and Portugal up 0.39%. So yeah, kind of just a mixed day across the European markets, some up, some down. In Russia, the MOEX was down 1.92% today, and the RTSI down 2.04% today. And then the Asian markets, Japan, the Nikkei was down 0.17%. Australia was down 0.2%. New Zealand up 0.27%. In China, the Shanghai was up 0.97%. The Shenzhen Component up 0.79%. China A50 up 2.16%. DJ Shanghai up 1.08%. Hang Seng up 1.57%. And the Taiwan weighted down negative 0.41%. So the Asian markets were a little more consistent, or at least in China. And then, like I said, the European markets, just like I said, back and forth. And, strangely here, domestically, things really rallied here in the last bit of the day. Oh, wow. The mail truck is, let's see what is 207 where I'm at right now. Mail truck is here like 3 hours early. They only show up early on Friday. So it's a mystery. All right, let's go ahead and move over to the market recap. U.S. stocks fall as Fed minutes confirm. No rush to cut rates. Nvidia earnings are eyed. All right, on Wednesday, U.S. stocks faced a downturn as Nvidia encountered pre-earnings pressure, exacerbating losses in the tech sector. Sentiment worsened post the release of the Federal Reserve's January meeting minutes, revealing members' concerns about premature interest rate cuts. The minutes signaled the Fed's reluctance to pivot towards rate cuts, citing uncertainties surrounding the duration of a restrictive monetary policy stance. Despite expectations, Nvidia's robust quarterly results with projected earnings per share of $4.58 and revenue of $20.37 billion, the chipmaker stock declined over 3%, reflecting doubts about its outlook and an overextended price-to-earnings ratio. Meanwhile, Palo Alto Networks tumbled over 28% after slashing its full-year guidance due to strategic shifts, including increased free product offerings to customers, which are anticipated to impact billings growth. Teladoc plunged 25% on disappointing first quarter guidance, attributing to the downturn to lower marketing spending on its BetterHelp therapy platform. SolarEdge Technologies also experienced a 12% decline, projecting weak first quarter revenue guidance amidst inventory overhang, despite management efforts to boost margins. Wingstop witnessed a 5% drop despite posting better than expected fourth quarter earnings. Isn't that just the way it is? I mean, you have better earnings than you expect and you still lose share price. Overshadowed by its fourth consecutive quarterly revenue decline. In index news, Amazon rose 0.3% as it prepares to replace Walgreens Boots Alliance in the Dow Jones Industrial Average, following Walmart's decision to undergo a 3-to-1 stock split, altering its index weighting. Amazon's inclusion will increase its weight to 17 out of 30 stocks, while Walmart's weight will decrease to 26 from 17. All right, well, that's everything that's going on in the market. It's kind of a light day as far as news. I mean, there's just, I'm just, perusing through the business news and the markets news and all the, all that sort of stuff. Just, I mean, a lot of it's just everyone. I guess everyone was just, waiting to dive into the Fed minutes and see what they had to say. So. All right, next up, we got an article from Zero Hedge titled FOMC Minutes Show Most Officials Fear Risk of Cutting Too Quickly. Staff mention financial stability issues. And this comes from Tyler Durden. All right. The Federal Reserve's recent minutes from its January meeting indicate a cautious approach towards interest rate cuts, with policymakers expressing concerns about the risks associated with moving too quickly. Despite ongoing discussions about the possibility of easing the policy stance, the Fed emphasizes the importance of assessing incoming data to ensure a sustainable decline in inflation to the 2% target. And again, I talked about this yesterday. Again, that's why it was such a brilliant episode. If the economy is as robust and excellent as the dorks on TV and out of the government, try to gaslight us with, if everything's fine, why do we got to lower rates? Seriously. Like I said yesterday, continue to ratchet up rates at, 0.25%, or if you want to do it slower, 1/10%. I don't care. Until the economy starts to actually, slow a bit, then you've hit your neutral rate. And that's where you leave it until things, either get hot again and then you continue to raise rates, or if they start to cool off, then maybe you start, you crank them down a little bit. So that's the way the Fed is supposed to do things, not, willy-nilly, hey, let's print $6 trillion, dump it into the economy, and then stand around like, oh my God, I don't know what happened. It's weird. Where'd all this inflation come from? You're the arsonist, the Fed. I mean, come on. I'm sorry, I get a little passionate about this stuff. Rate cut expectations have diminished since the January meeting, with March now unlikely and a reduced forecast for total cuts in 2024. Treasury yields rose notably as a result, reflecting the market's adjustment to the Fed's dot plot reality. The minutes highlighted various factors influencing the Fed's decision-making process, including concerns about financial conditions becoming less restrictive, potential disruptions to supply chains, and geopolitical risks. Additionally, Fed officials acknowledged the recent surprise in inflation data and expressed caution regarding financial stability issues, particularly high valuations across markets and declining commercial real estate prices. Despite some positive economic indicators, Fed staff remained cautious, noting downside risks to the economic forecasts and expressing concerns about the sustainability of progress in lowering inflation. Moreover, Fed Governor Michelle Bowman indicates that the current economic environment does not warrant interest rate cuts, suggesting a stance of vigilance and readiness to respond to evolving conditions. And again, what it really stems from is everyone just wants cheap money. And, the more cheap money you got, that helps out, the big banks, Wall Street, all that sort of stuff. And, it really just squeezes the little guy because you can't make any money on your, cash reserves or anything like that. I mean, when, you're making 0.25% or 0.5% on, the money you have sitting in your bank and bank accounts and, CDs and things like that. That's, for your kind of your short-term emergencies. How are you supposed to live with or deal with that? And, a lot of people have been pushing their, what would be their short-term reserves into the equity markets, which, again, is that really a good idea? Especially as well, as many have said, is how overvalued the current market is. You should have your cash reserve in there and then it goes down by 10 or 20%. That's not a good thing. So, all right. Last up, I got another article from Zero Hedge. It's titled, "Are the Magnificent Seven in a Bubble? Ask the Nifty 50." And this was from Michael Leibowitz of realinvestmentadvice.com. All right, in a detailed commentary by Michael Leibowitz and published on realinvestment.com, the phenomenon of narrative-driven market manias is explored, drawing intriguing parallels between today's Magnificent Seven stocks and the iconic Nifty 50 of the late 60s and early 70s. Despite the absence of the same companies, both groups share unique valuation and narrative threads that captivate investors' attention and drive market dynamics. The Nifty 50, a collection of esteemed growth stocks like Coca-Cola and Walt Disney, represented a pinnacle of investor enthusiasm during their era. These stocks were characterized by solid earnings growth, innovative business models, and an aura of invincibility that led investors to assign hefty valuation premiums. However, this exuberance eventually gave way to a speculative bubble that burst amid the market downturn in 1973, before I was born by a year. Contrary to the popular belief, subsequent analysis suggests that the Nifty 50 stocks were not inherently overvalued at their peak. Instead, they experienced a loss of investor confidence during the downturn, leading to substantial declines in their market value. Over the long term, however, those who held onto these stocks fared relatively well compared to the broader market, with earnings growth aligning closely with initial valuations. Drawing from this historical perspective, Leibowitz poses critical questions about the current valuations of the Magnificent Seven stocks, which include prominent names like Apple, Amazon, and Tesla. By examining current PE ratios and projecting earnings growth rates, investors can assess whether these stocks are priced in accordance with their future growth potential or are susceptible to speculative bubbles. While some argue that the market may be underestimating or overestimating the current growth potential of these stocks, the primary risk lies in investor confidence. As Benjamin Graham famously stated, in the short run, the market is driven by sentiment, but in the long run, it reflects underlying fundamentals. Therefore, investors must carefully evaluate the sustainability of earnings growth implied by current valuations to navigate these narrative-driven market environments effectively. In essence, Leibowitz's analysis underscores the importance of understanding historical market dynamics and applying critical thinking to assess the validity of prevailing narratives. By doing so, investors can make informed decisions amidst the excitement and volatility of today's market landscape. It's good advice. All right. Well, that's everything that I had for today. If you need anything from me, hold on. Let me get my banner up here. Go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you guys next time. Adios.